Stocks trade soft today, but there's no sell-off despite a sharp fall in the U.S. indices overnight. Now, financials and metals are the big drags, even as energy and utilities eke out gains.
Axis Bank slumps on reporting a weak performance with growth slowing in advances and deposits. Profitability takes a knock and slippages see a sharp rise. Return ratios too are the lowest in 5 quarters.
L&T manages to beat expectations despite the elections, heat wave and labour shortage hurting execution. And while the order accretion remains healthy, the pipeline sees a trim, the stock perks up.
SEBI study spanning 86% of retail client accounts in the cash segment reveals that 7 of 10 intraday traders incur losses, with those aged under 30 faring far worse. What's more, despite this, the number of intraday traders grew 300% in FY23 in a worrying sign.
CNBC-TV18's town hall with the secretaries from the Finance Ministry sees some key revelations. The 12.5% LTCG tax rate won't change. Withdrawal of indexation on realty won't be reversed. STT on F&O is only a small nudge to curb speculation. Hello and welcome. You've tuned into Business Lunch. I'm Nisha. With me, as always, is Hormaz and flashes on the screen. In fact, it's a heavy earnings season right now. And let's address the impact of Ashok Leyland's numbers that are just trickling in on that particular counter as well. It's a slight miss on both revenues as well as on net profit of the company compared to CNBC TV18's poll. And the stock is down over 2% and inching towards 2.5% drop at the particular moment. We are awaiting more numbers coming in terms of the operational performance. Revenues are up 5% on a YOY basis. But remember, it's slightly lower than what CNBC TV18 poll suggested, and on net profit as well, it is slightly lower at 525.6 crore rupees. And the stock has seen weakness after the results have trickled in. In fact, EBITDA is up 11%, 911.3 crores for that, and margin at 10.6 versus 10% YOY, so it's 0.6% of rise when it comes to margin, but that's on a YOY basis. So those are the numbers, but the stock has been plummeting on the back, and there is some weakness seen, 2.8% down on Ashok Leyland. While looking at the rest of the market, while more numbers trickle in from Ashok Leyland, and we'll focus on that, Nifty 50 on the flat line with a negative bias right now, 20-odd points lost. Some of the big heavyweights have recovered in the last half an hour of trade, and therefore there is a steady recovery seen, but still it's in the red zone. Now, when we talk about Bank Nifty, that is clearly underperforming the key indices today, taking the big hit, 0.87% down in trade. But if you really take a look at Nifty 50, from the point it opened, now it is above about 150 points higher. So there is some bit of trickling in of some bit of buying at lower levels that is clearly seen. Mid caps is being resilient also on the flat line, but the entire screen is on the red side. Advance decline ratio in favor of the advances, buoyed by the broader markets. On my screen at the moment, Axis Bank, Nestle, Shriram Finance, Titan, as well as some of the metal counters are the ones which are taking a knock, while tech titans are the ones which are saving the day-to-day. Hormaz.
Coming back to Ashok Leyland's numbers, actually, you can call that a slight miss, but on the top line and bottom line front. But the margins look steady, 60 basis points expansion compared to the year-on-year basis. But as you were mentioning earnings, it's a very earnings-heavy day, and that has been the trend over the last couple of quarters. The good earnings are getting rewarded disproportionately, and on the flip side, any slight miss, you can see that in Ashok Leyland as well, and pull up Nestle as well. The 1% volume growth that the company reported in its first quarter quarter compared to expectations of around 5 to 6%. That's showing up on the stock as well, now 3% lower on Nestle. So that is the earnings reaction that we are seeing. Some of the railway PSUs are selling off today. IRFC is down for the eighth straight day today, and that's the longest losing streak that the stock has seen since 2021. So 3 years, the longest losing streak, 8th day of losses for IRFC. And the shipbuilders as well, Masgao Dock, Cochin Shipyard, Garden Reach, all of them have corrected at least 20% each from their respective record highs, which they had hit just earlier this month. But staying with earnings, and we are mentioning that a slight miss is getting punished, and one of such names is Axis Bank, and that is the top loser on the Nifty as we speak, 6.5% lower, and that is after the bank reported an operationally weak set of numbers in the first quarter. Abhishek is joining in with more details. Abhishek.
The raw material. Now that's a struggling factor for Axis Bank because deposit growth is at 12.8% YOY. This is the weakest growth that you are seeing in last 6 quarters, and sequentially deposits are down 0.6% quarter on quarter, and that's perhaps the highest decline that you are seeing in last 4 quarters. So that has also led to weakness in loan growth. So loan growth is at 14.2% YOY and about 1.6% on a sequential basis YOY, and quarter on quarter this is the weakest growth in last 8 quarters. Now operating profit has declined 4.1% quarter on quarter, the weakest growth rate that you are seeing in last 8 quarters. Core operating profit growth is just 1.3% sequentially, which is the weakest rate that you are seeing in last 4 quarters. Talking about asset quality, the woes are higher than street estimate. So the slippages have come in at 4,793 crore. Analysts were working with a number of 4,000 to 4,500 crore. This is largely led by the unsecured or the retail segment as well. Annualized slippage ratio is at 6-quarter high of 1.96%. That's driven the credit cost to be the highest in last 12 quarters at about 1.04%. Analysts were penciling a credit cost of 0.45 to 0.5%. And the guidance from the management is that going ahead, credit costs will rise, and the best is behind with respect to FY24 credit cost. Gross NPA ratio has increased quarter on quarter for the first time in last 12 quarters, and that's a disheartening factor as well. Watch list has increased by almost 11% on a sequential basis. This has impacted the return ratios. Both the ROA and ROE are one of the weakest that you are seeing in last 5 quarters. ROA at 1.65% and ROE of 16.3%. Now CASA ratio is also one of the weakest in last 16 quarters, coming in at 41.8% versus 43% in the previous quarter. But this is an industry phenomenon wherein you are seeing CASA ratio decline for majority of the banks. PNL, both the ANA and PAT is on a beat on our poll, but they have a one-off income with respect to interest on income tax reversal of about 100 crores in this PNL. Back to you.
All right. Thanks so much, Abhishek, for getting us all those details. And Hormaz, of course, the deposit growth is a concerning factor for the entire banking sector. And a few points on that is that, 3 to 4% on saving deposit rates when the interest rates have risen. And on the other hand, equity market giving us better returns. So the country is very, very aware of where they are making money. So banks feeling that heat. Now, L&T, on the other hand, is rallying on the back of its first quarter numbers, and Vivek joins in with the fine print and the impact. Tell us, Vivek.
Well, good afternoon. So L&T, what actually transpired in the quarter gone by was that it was expected to be a slightly muted quarter in terms of execution, and largely it's played out that way. So execution was impacted by the ongoing elections, the heat wave, as well as labor shortage, given the fact that most of the laborers had gone back to their villages. Now, despite that, what's actually happened is that execution was strong in the international business, and that was something that helped. The order prospects, however, for this particular quarter that the company guided the street to is slightly soft, down almost 10% on a year-on-year basis. Despite that, the lack of any negative surprises is something that has buoyed the street, and the stock had also underperformed going into the results. Now, talking about the numbers themselves, the revenue was a beat to our own poll. 55,120 crore was where the revenue stood at. Margins at 10.2% and profitability coming in close to the 2,785 crore versus our own poll of 2,870 crore. So a slight miss over there. The order inflows are something that the street is taking quite a bit of heart from, up almost 8.3% on a year-on-year basis. While this tracks slightly lower compared to the management's guidance of 10% order inflow, given the fact that this particular quarter was seen to be marred by elections and ordering activity was slightly soft, the street is taking it quite positively, and the management, more importantly, has not gone ahead and changed any of the guidance, including the order inflow guidance of 10%. Now, talk about the core business margins. Remember, the company has given a margin guidance of 8.25%, for FY25. Core business margins came in at 7.6%, expected to be weak in this particular quarter. What is positive is that 20 basis point higher compared on a year-on-year basis. So Q2 and H2 is something that will have to do a lot of heavy lifting in terms of margin recovery. And order prospects, is now 9.07 trillion versus what was earlier seen at 10.07 trillion. So that is the only blip in an otherwise strong operational performance from L&T this time around.
Well, as they say, no bad news is good news, and that's showing up on the stock price as well on L&T, almost 3% higher now as we speak. Vivek, thanks a lot for that update. Moving on to weather now, and it's been pelting down here in Mumbai. And not only in Mumbai, heavy rains have lashed parts of Pune and Raigad as well. And the rains have led to traffic jams, waterlogged roads and overflowing lakes. Sandhya is here to tell us more. Sandhya, what's the latest update?
Heavy rainfall continues to lash Mumbai and the nearby regions. Right now, we are in Mumbai's Santa Cruz area. We are actually outside Air India Colony, and you can see the waterlogging. You can see how bad the situation is. Similar to the situation in the rest of the low-lying areas of the city, whether it's Science Circle, Gandhi Market, Parel, Hind Mata, Dadar, parts of Govandi, Mankhurd, Borivali Station, parts of Andheri, parts of Santa Cruz. All these areas are witnessing massive waterlogging. That waterlogging, the heavy rainfall, has led to traffic diversion on multiple routes. Heavy traffic started bothering Mumbaikars early in the morning. Other than Mumbai, Navi Mumbai, Thane, Kalyan, Mumra, all these areas, parts of Palghar, are also witnessing heavy rainfall, which has led to massive waterlogging. Only silver lining in this cloud is that the water levels of the lakes which supply drinking water to Mumbai, the levels are now 66.77%, slightly better than last year, but still a long way to go. 3 out of 7 lakes have started overflowing. So one less thing for Mumbaikars to worry about. As I said, the only silver lining in this cloud, heavy rainfall is expected to continue to lash these parts of the Mumbai metropolitan region. Other than that, Pune is witnessing heavy rainfall, which has led to massive waterlogging in multiple parts. And NDRF has deployed 3 teams in the city, and rescue operations are underway. Other than that, NDRF has deployed teams in Mumbai, Thane, parts of Raigad, Pune, Nagpur, all these places. There's a landslide reported in Lavasa city. NDRF has rushed 1 team to that spot as well. 3 to 4 people are feared to be trapped. So rescue operation there also are underway. So as far as the IMD's warning is concerned, the heavy rainfall is likely to continue for another couple of hours at least, and after that the next warning will be issued.
All right, Sandhya, they're braving the heavy rains and getting us the ground report. Yes, the business districts of Mumbai have been affected by the traffic snarls. So that's also a very big concern coming in. With that, we'll slip into a short breather on Business Lunch, but we'll get you more news and updates on the other side. Don't go anywhere.
Back with us here on Business Lunch, and pull up Ashok Leyland. That stock has seen a very sharp recovery from the lows of the day. Then that's because of the guidance that the company has given in its press release post the results. The industry volumes comparable at levels of the previous peak, but the margin guidance is what the company is given, and that is what has led to this recovery in the stock price as well from the lows of the day. The mid-teens margin guidance is what they are saying. There was margin pressure in the first quarter is what the management said, but they are now guiding for a mid-teens margin, and you can see the stock has now from almost 3% lower, it's now down to less than 1% as we speak, 230 there on Ashok Leyland. But moving on then, in a big setback for the miners, the Supreme Court has rejected the plea by miners and Centre against the levy of cess by the states. Now Ashmit is joining us with more details. Ashmit, what's the latest that you're picking up?
Well, in many respects, this is a landmark judgment. It was pronounced by a 9-judge bench. It's coming after 9,000 days of waiting. This first case was filed way back in 1999. What is the issue at the heart of it all? Well, the core issue that was being argued here before the apex court is that can the state governments prescribe a cess by their own legislative competency? Can a state government pass a law saying that, or basis the mineral output, a certain percentage has to be paid in the form of cess or tax? The answer is yes. An affirmative answer coming in from the apex court, the Supreme Court saying that yes, indeed, the states do have the legislative competency to go ahead and to pass such laws which provide for paying of cess. This is a burden that will fall on the miners. In terms of the impact, there are 4 aspects to consider. Number 1, the impact on the miners themselves. There was a big question mark over payment of these cess, payment of these levies, of this tax to state governments. That has been answered. So that squarely falls on the shoulders of the miners. The Supreme Court has said that basis the mineral output, the state government can compute a cess that has to be paid by them. So a huge impact as far as miners are concerned. Speaking of the miners, who are the miners that were here before the apex court? The likes of Hindalco, Tata Steel, Ambuja Cement, ACC. All the big names were here contesting this state levy. That answer they've met with a disappointing answer from the apex court. That burden will now fall on the miners. In terms of the impact also on the state governments, let's bear in mind that mineral-bearing states, the likes of Odisha, Karnataka, Maharashtra, Rajasthan, Jharkhand, Chhattisgarh, MP, these are the larger states which bear these mines. These states are looking at thousands of crores of revenue coming in over the course of a mining lease. That's 2. Second, as far as the impact on the centre is concerned, this is a huge hit for the centre as well. The centre, bear in mind, has been arguing before the apex court that this power of taxation falls exclusively in the domain of the centre, that the states have no business levying this tax. They've been met with a disappointing answer as well. The centre's petition being disposed of by the apex court. So again, a big landmark judgment coming in from the apex court in terms of miners, pain coming in for them in the form of additional cess by way of state governments.
Thanks for that, Ashmit. Yes, all those perspectives well taken. But remember that the mineral-rich states, a lot of them are not as economically abundant, and therefore they are taking a share in the pie of the resources that are mined in their own state. With that, we'll slip into a short breather. But up next, we speak to the budget makers themselves as they clarify on the fine print of the new taxation measures announced in the union budget. Stay tuned. Welcome back. You're watching Business Lunch, and the numbers trickling in for Canara Bank, and that stock is also seeing some more pressure building in, about 2% down on the back of some of the numbers missing. CNBC-TV18's poll saw the net interest income at 9,100 odd levels and net profit at 3,900 levels. There's a slight miss on both the fronts compared to CNBC-TV18's poll. We'll have to see the asset quality, deposit growth, and all those parameters which have been impacting the banks, and waiting by for more numbers to trickle in. But Canara Bank down about 1.5 to 2%, and it's adjusting to the numbers, and more to see when more numbers and the perspective on these numbers also trickle in. Let's focus on the budget now. Finance Minister Nirmala Sitharaman tabled the first budget of NDA 3.0 on Tuesday. Now, the 25-minute budget speech had the stamp of continuity, constancy, as well as coalition. Now, last evening, the budget makers, the secretaries from North Block, decoded the budget fine print on CNBC-TV18, and Finance Secretary TV Somanathan ruled out a rollback of the decision to remove indexation benefits for the real estate in the budget, and said that they were prepared for the blowback. Now, Revenue Secretary Sanjay Malhotra called the new tax structure on property sales fair. Take a listen.
Is there a possibility of a review? Do you take on board
It is not my job to discuss what the minister will say in her response, but I personally am not in favor of a review. I think our view is that investments need to be determined by inherent economic considerations, not by tax arbitrage. For the vast majority of people, including the overwhelming majority of the middle class, I don't think this is a significant issue. And I think for most of them, they will end up preferring the 12.5% without indexation because it will actually be lower if, in fact, real estate returns are good. If real estate returns are not good, then it might break even, and there may be a few cases where there's a slightly negative impact.
Now, many are saying that with the removal of indexation benefit, people stand to lose, and perhaps there is a need to review the numbers itself.
Absolutely not. I feel, that the people will, the vast majority will actually, lose if we were to go back to the old system. It's not in their interest to go back to, indexation with a higher rate of taxation, which is 20%. So we have done our calculations. If at all for some who were not paying these taxes, if it is going up to 12.5%, I think it is fair for everyone to pay those kind of taxes.
Now, the union budget allocated around 19,100 crore to the Ministry of New and Renewable Energy to scale up green hydrogen and alternative energy schemes in the country. Now, the MNRE Secretary Bhupinder Singh Bhalla reveals plans have already taken form. Listen into what he had to say.
It's very quite rudimentary. You ask me what the main schemes are, and I'll tell you in PM Suryagar, this is what I want to do. I want to escalate installations in PM Suryagar. I want to escalate installations in PM Kusum scheme, which we now a lot of progress which is happening. More important, GEC, the Green Energy Corridor, we want to close whatever remains for phase 1, but start progressing on phase 2 on a very fast scale. Green hydrogen, there are a lot of things happening. Green hydrogen production capacity, ammonia bids, aggregation for green hydrogen, for refineries moving on to using green hydrogen. Apart from that, pilots from transport, in the transport sector, in the shipping sector, in the steel sector, all these projects are moving ahead. Of course, and we also have, of course, the R&D project, which we'll be announcing in the next couple of.
Let's cut across to Shireen Bhan, who is in conversation with DEA Secretary Ajay Sheth.
Welcome to CNBC-TV18 special. The budget verdict continues, and we are in conversation with the budget makers themselves. Joining us now on the program is the Economic Affairs Secretary, Mr. Ajay Sheth. Mr. Sheth, thanks very much for joining us again on CNBC-TV18 for a much more detailed conversation than we had on budget day itself. I want to understand from you, sir, to take forward what the FM said in her speech as far as the fiscal consolidation roadmap is concerned and the outlook from here on for the government. And I'm quoting from the speech, the fiscal consolidation path announced by me in 2021 has served our economy very well. From 2026-27 onwards, our endeavour will be to keep the fiscal deficit each year such that the central government debt will be on a declining path as a percentage of GDP. While the fiscal consolidation glide path has been mapped out by the FM, what about the debt side, sir? What's the expectation that we should realistically have in terms of the debt levels that the government wishes to achieve within this period as well?
Okay. See, conventionally, debt management for public debt management has been looked at from the perspective of the flow as a parameter. How much governments should borrow in a particular year. But when we look at the sustainability of debt, what is relevant is the stock of the debt, which has a far more lasting impact because one can adjust the annual accretion to the debt stock. But whatever one has accumulated over the years, that has to be brought to the sustainable level. Keeping that in mind, what Finance Minister has announced that government has delivered and is committed to deliver even next year the glide path from 2021 till the next year. What next? As a forward guidance to the market, an approach has been suggested what government intends to follow from the financial year 26-27. Is saying that if you are looking at bringing the total debt stock to a sustainable level, then the primary or the most relevant parameter itself, let's anchor our efforts to that one itself, which is total debt stock to GDP ratio.
Right.
And every year we try to chip it away from there. And if you recall that pre-pandemic, country was, or central government debt was around 48%. This ratio was around 48%. Because of the pandemic, it went up to almost...
Went at about 56.
It went up to 50, 61.
Yeah.
Now we are 56 plus,
right.
Meaning that over 4 years we have come down by about 5 percentage point. Moving forward, every year it has to be reduced so that we reach to a more sustainable.
So what is that quantum that you realistically believe that you will be able to chip away, in your words, every year?
So the policy intent has been initiated by Finance Minister. Now it is for us now to work out the ways how to operationalize this. We have certain ideas how to put it together, but that call has to be done, that what kind of a glide path has to be done over the course of next 1 year.
So what are the options on the table? You said that the work has, obviously some background work has been done and decisions will have to be taken on the route forward. But what are the options on the table?
So the options in the sense that why this shuttle shift has been thought of, and it's not, this is several economists have been talking about it, the public finance people who have worked in that area have been talking about it, not just in India but even abroad, is that different economies based on their pace of growth and the structure of the economy have the need for governments to play a particular role, as well as have the absorptive capacity to sustain a particular level of debt. Considering that India has been growing in the last 4 years or 3 years at a good pace, and we have the confidence that even in the future, for foreseeable future, we can maintain that at a higher level. We have both the need and the absorptive capacity for a higher debt. But of course, it has to become a more sustainable. At the moment, 56% plus ratio is certainly an elevated level. It has to be brought down. So keeping that in mind...
What would be a comfortable level? You acknowledge the fact that 56 plus is an elevated level. What would be a comfortable level as far as debt is concerned to your mind?
See, we have a long way to go on that particular one. As I mentioned it, the pre-pandemic, the debt level was 48%. So the first goal would be to reach that level. But that has to be over a period of time. It can't be a sudden one. These are the accumulated debt. But what should be, with what period it has to be achieved that level will have to be, that is a work which we have to do. Look it into the conditions of our economy and to do so. What it gives a flexibility that there can be years wherein there may be a need to calibrate how much government has to do in that particular year. It also gives a scope to the government to follow a counter-cyclical policy in terms of the fiscal support to be provided, rather than getting tied up to a fixed 3% limit. There's a purpose.
A couple of factors that you will now also need to consider as we get to that 2026-2027 roadmap. The Finance Commission recommendations, which will have to factor in the kind of devolution that will have to be granted as far as states are concerned. And on the GST liabilities, sir, do you believe that there is any possibility or any chance of being able to advance the payment as far as or extinguishing the GST liabilities to states is concerned?
See, as far as the two factors, I am glad that you brought up that aspect. Yes, from the financial year 26-27 will be the first year when the recommendations of the 16th Finance Commission would be applicable. Obviously, that will be an important factor to decide what kind of a glide path would be possible. But on the issue of a GST compensation, our assessment is that it will take about 12 months to take care of the loans which Government of India had taken to compensate the states for the period when the GST growth rate was fairly low and the 14% was promised to them.
So, as and when the liabilities are extinguished, what then, sir, if we continue to see a shortfall at the state end on account of GST, is there a possibility that this compensation cess in another name will continue to be imposed, or is there a possibility even as far as a higher rate is concerned on that?
See, as far as what the sort of a pact was made in 2017, that Government of India assured that 14% growth will be will be assured for the next 5 years. And to the extent there is a shortfall in any state, there would be a state will be compensated. And that commitment has been completed. Now, what happens to the compensation cess, say next year, when this liability has been completed, has been taken care, is for GST Council to decide. Government of India may have a particular view on that, but it's the council which will take the decision.
What is the Government of India's view on that, sir?
That will be discussed in the GST Council rather than in a press interview.
Okay, let me talk about some of the other factors that the finance minister spoke of, or some of the policies that the finance minister spoke of, which are really work in progress. And let me start by talking to you about the financial sector reforms. Yesterday, the finance secretary said that this is not going to be something that's going to be addressed in the next 6 months or even perhaps the next 1 year. Efforts will be made to start the consultation process, but it's not as if we should expect an announcement on this front in the next budget. Can you tell us what the scope will be, what the ambit is as far as this financial sector, overhaul, reform, roadmap is concerned? What is the thrust area? What will be prioritized? What is the thinking at this point in time?
Okay. Look at that in what context Finance Minister made that announcement. She was talking about next generation reforms. And next generation reforms in 4 areas. 1, 3 factors of production: land, labor, and capital. And if you notice, for a land sector reform or land as a factor of production, there are very specific ideas are there, specific actions have been identified. There are few elements of labor related services, and then there's a fairly decent chunk on the financial sector. Obviously, when country at the moment is about 335 lakh crore of our GDP size, and we say that over next 20 years, 25 years will become 8 times the size, and every year that kind of a growth is happening. Financial sector has to become a much larger one, and Finance Minister in the interim budget itself has said that we will prepare the financial sector in terms of the capacity, size, and the skills. Now, keeping that in mind, what is the vision? Not just the vision, but what is the strategy to reach there? And that will guide the work of the government, that will guide the work of the regulator, that will guide work of the market participants as to which direction the financial sector to serve the real economy. Now, that is a kind of a fundamental work which we propose to initiate now and complete it in foreseeable future.
And I understand that there is no timeline that's been put in place by when you expect to complete this. But you were talking about the financial sector. Let's talk about banks in particular. And the aspect that's been brought to the table several times previously is that we need not just world-class banks, but we also need world-size banks. In that context, what is the thinking? We've seen one spate of consolidation as far as PSBs are concerned, and then nothing. Nothing has moved as far as privatization goes. What do you believe is the future as far as public sector banks are concerned? What is the thinking at this point in time that the government has with regards to PSBs specifically and their need to service a much larger economy?
See, for some of these items, one cannot force the pace. It has to be that whatever has been done in the past, it has to be consolidated, and thereafter the next set of consolidation will have to come in. That conversation continuously happens between the government as government as a policy maker, as well as the government as owner of the public sector banks, as well as with the RBI as a banking sector regulator, and the decisions get taken at appropriate point of time. So we can't set a timeline as to when the next set of consolidation will happen. At the moment, the pace of Indian banks becoming bigger is moving pretty well. And if you look at what is the size of SBI, it is about 20% of our GDP. Their balance sheet size is about 20% of the GDP. Of course, these are the two different ones, but it is a good metric to follow. That what is the largest bank in the country? What is the balance sheet size?
So, do you believe that there is a need to look at the possibility of consolidation, or leave things as be and let market forces determine?
See, some of these ideas, what you are asking the question, these are the questions one has to, precisely the kind of a question one has to will be grappling with those issues
in the financial sector
strategy
reforms.
part. So one is a vision part, like what you initiated.
Yeah.
India should have not just large bank proportional to Indian economy, but with reference to the global economy, we should have a large bank. Now that's a vision. But then what is a strategy to reach there? And what kind of a time frame one may have in mind? Those kind of an issues which this paper is expected to bring out.
Okay, speaking of work in progress, the energy transition roadmap, also something that the finance minister spoke of. And again, specifics are yet to be worked out, but give us an indication of where the thinking is and what the next steps are expected to be on that front.
Okay. Now, that is again, I'll call it as a second piece where there's a continuity from, or there's an anchor for that particular one, was done in the interim budget itself. As part of the strategy for Amrit Kal, Finance Minister talked about that one of the elements of the strategy was ensuring energy at affordability, accessibility and availability. All three elements have to be there. In Indian context, we need to grow. Per capita consumption of energy is low. We can't grow and we can't become a higher income country without increasing our energy consumption. At the same time, we have to become a lot more efficient than what we are. Keeping that in mind, that our purchasing power, which say about $2,007 per capita income versus what it may be, say, in Europe and others, advanced countries, of $50,000 per capita. The solutions for an energy transition for India have to be entirely or quite different than what it can be for an advanced economy. So in that path, that what kind of a transition pathway we adopt so that there are no constraints to growth. At the same time, the climate action, ambition and the need and the responsibility of the country can also be met. Now, we are doing within Department of Economic Affairs along with Asian Development Bank, trying to get that a structured study that where lies the trade-off, what can be a more sustainable one which we can help us keeping our growth rate high, which implies that our energy consumption will grow up. At the same time, we are towards a path of efficient energy users. At the same time, NITI Aayog is doing a lot more comprehensive work. So the idea is that in about 6 months' time or before the next budget, come out with a pathway, that the second policy paper on the energy transition pathway for the country.
So this is likely to be completed within 6 months of earlier than the financial sector vision and execution roadmap that you spoke of. So this could perhaps find its way into the next budget?
Certainly, that is an idea that each of these works which will be, which we have done preliminary work and we would be starting it, it does require fair amount of consultation with the stakeholders and coming out. The idea is to keep on informing the policy making. Like this, even this budget has a fairly strong package on what we need to reach to the energy security. There are specific 5 items have been indicated there, but that's not the end of the requirement. The requirement is a lot larger. So as and when or as we are completing our policy work or this conceptual work is getting, it keeps on informing the policy. It doesn't mean that it has to become 100% complete, only then it is available, relevant for the policy.
Well, speaking of